Volkswagen's historic move to consider factory closures in Germany for the first time in 87-year history.
China is taking over the European auto industry, and it seems they are starting with Germany and Volkswagen. Chinese automakers are expressing interest in acquiring Volkswagen's underutilized factories in Germany, aiming to establish themselves at the heart of Europe and take control of the electric vehicle market. Could this be the end of Germany's legendary auto industry and the beginning of China's total domination? What does this mean for Germany, Europe, and the global auto industry? China taking over Volkswagen is such a big deal because of how important Volkswagen is to Germany as a country and the people. This is not just any car company, it is the pride of the nation. Volkswagen was founded in 1937 in Wolfsburg. VW quickly made a name for itself with iconic vehicles like the Beetle and the VW Bus. These models weren't just cars. They were symbols of post-war Germany's resilience and progress. After World War II, VW played a pivotal role in the country's economic recovery, helping fuel what came to be known as the economic miracle. Over time, VW expanded its reach globally, acquiring prestigious brands like Audi, Porsche, and Bentley, solidifying its place as one of the largest automotive groups worldwide.
It employs 680,000 people around the world. It has dozens of production locations. Millions of people, workers in other industries, are reliant on the business that they get from this company.
Today, Volkswagen is still a powerhouse. As of January 2025, its market capitalization stands at around 54 billion euros. In 2023, VW generated a staggering 322 billion euros, or $351 billion in revenue, securing its place as one of the top companies by revenue. The company isn't just big in terms of numbers, it's also a huge employer in Germany, with approximately 300,000 people working for the company. Globally, VW operates 114 production facilities, with a significant portion of these located in Germany, underlining the company's central role in the national economy. The German auto industry, with VW leading the charge, generated over 558 billion euros in revenue in 2023. Volkswagen's importance goes beyond just its size and profitability. The company is a symbol of German engineering excellence, a benchmark of quality and innovation that the world looks to. As a cornerstone of the German economy, its success directly impacts the livelihoods of many and plays a significant part in the country's GDP. But with the industry facing rapid changes, especially in terms of sustainability and electric vehicle innovations, what's next for VW? The outlook isn't promising, and that's why whispers of a Chinese takeover are growing louder. But before we dive deeper into this unfolding story, make sure to hit the subscribe button. It helps us bring these critical stories to a wider audience. Thanks, and now, let's get back to the video. While the world shifts gears toward electric vehicles, EVs, German automakers like Volkswagen, Mercedes-Benz, and BMW seem to be lagging. Challenges like high labor costs, inconsistent government policies, and a lack of innovation have left them playing catch-up. It doesn't help that the sudden end to EV subsidies in 2023 and poor charging infrastructure have dampened local sales. Even Volkswagen, a titan of the industry, has announced major job cuts, signaling just how deep this crisis runs. Meanwhile, the competition isn't waiting around. The US and China have raced ahead, claiming the lion's share of the EV market. The US has poured $370 billion into clean energy projects through initiatives like the Inflation Reduction Act, aiming to transform itself into the most profitable EV hub on the planet. China, however, has taken a more aggressive approach. By prioritizing EV development as part of its national strategy, it has not only skyrocketed production, but also seized 76% of the global EV market. Brands like BYD and CATL are now household names in EV technology, with CATL dominating global battery production. This kind of dominance raises an unsettling question. Can Germany catch up? Well, it does not seem so, as the German auto industry is in crisis.
Massive layoffs, factory closures, and rising competition are shaking the very foundation of Germany's industrial strength.
The gap between Germany and China couldn't be more striking. While China rolls out affordable and innovative EVs at scale, Germany's market share continues to dwindle. Predictions are grim. 186,000 jobs in Germany's auto sector could vanish by 2035 if this trajectory isn't reversed. And it's not just a matter of market trends. It's a question of survival for an industry that has long been the backbone of the German economy. With such stakes on the line, this could be the end for German auto manufacturing as we know it. This could be the leverage for China to take over, as it is obvious that Volkswagen and others cannot keep up. That is not all. Volkswagen also has a lot of problems with compliance with European standards. Volkswagen estimates that compliance with the new European emissions standard, effective from January 1, 2025, could cost approximately 1.5 billion euros due to fines and adverse effects on sales. This standard mandates that new cars emit an average of 93.6 grams of CO2 per kilometer, a significant reduction from the previous 115 grams. The European Automobile Manufacturers Association projects that industry-wide fines could reach 15 billion euros, necessitating a 22% market share for electric vehicles to meet these targets. Volkswagen is ramping up its investments in the United States as part of its ambitious plan to double its market share. Currently holding around 4% of the US market, the company is targeting a 10% share by focusing on localization. Key initiatives include potential expansion of its Chattanooga, Tennessee plant, and increased investment in research and development. To attract customers hesitant to fully transition to electric vehicles, Volkswagen is also exploring the addition of range extenders to more of its models, aiming to broaden its appeal and accelerate growth in the competitive US market. Volkswagen's struggles highlight a broader crisis facing the German automotive industry. The company is contending with declining demand in key markets, including China, where it once dominated. Rising interest rates and sluggish sales have compounded its challenges, leaving Volkswagen increasingly exposed to the global economic slowdown. In China, a market that once eagerly embraced VW's vehicles, consumers are now gravitating toward more affordable EVs from both domestic brands and international competitors. Meanwhile, Volkswagen has invested heavily in shifting from conventional combustion engines to EVs, but these investments have yet to yield the desired results. In the third quarter of 2024, the company reported a staggering 41.7% drop in revenue and a 60% decline in profit compared to the previous year. This is a major blow, reflecting not just market challenges, but also deeper systemic issues within the company. One of the biggest problems is Volkswagen's underutilized factories in Germany. High operational costs and reduced competitiveness in the global market have made it difficult to maintain production efficiency. And to make matters worse, the German government, despite Volkswagen's iconic status and importance to the nation's economy, has shown no intention of stepping in to bail them out. Without that safety net, Volkswagen's future looks uncertain. Volkswagen might soon rewrite the playbook by teaming up with a Chinese car manufacturer within Germany. Imagine Chinese cars, crafted in VW's German plants, hitting the European roads. This bold move could boost factory utilization and leverage China's expertise in electric mobility. But doesn't it also raise critical questions? Who's truly steering the future of European car manufacturing? And why now? At a time when Volkswagen has long stood as a symbol of European automotive sovereignty. This collaboration comes as Chinese automakers eye German factories slated for closure, hoping to transform them into hubs to take over car manufacturing in Europe. China has its sights set on Volkswagen's struggling factories, and the strategy behind it is as calculated as it is ambitious. One major reason is to dodge the hefty EU tariffs on Chinese EV imports, which can exceed 45%. By producing electric vehicles locally in Europe, Chinese automakers can sidestep these tariffs and offer more competitive pricing, putting their cars within easier reach of European consumers. But it doesn't stop there. Setting up production in Volkswagen's facilities also gives Chinese automakers a chance to strengthen their foothold in Europe, a key market they're eager to dominate. Beyond just making cars, they see an opportunity to tap into Germany's highly skilled workforce and its sophisticated automotive ecosystem, known for precision and innovation. By associating with the legacy of German engineering and quality, Chinese brands hope to not only bolster their reputation globally, but also challenge the long-standing dominance of Western automakers. It's a bold move, one that signals China's growing ambition to reshape the global auto industry. China's presence in Europe's EV market is already a rising concern. 6 of the world's 10 best-selling EV brands in 2023 came from China, with BYD stealing Tesla's crown as market leader. What's even more striking? Chinese brands surged from a mere 3% market share in Europe to now targeting a 25% share, and their growth isn't showing signs of slowing. Is this the natural evolution of global competition, or is Europe giving up for a new era of dominance? The numbers paint a stark picture. Over 438,000 battery electric vehicles from China entered Europe in 2023, valued at nearly 10 billion euros. That's a 20% market share in just 3 years, powered by competitive pricing and cutting-edge technology. Yet not everyone's happy. German officials are already voicing concern, fearing that domestic automakers are losing ground to their Chinese counterparts. The EU's recent decision to impose tariffs of up to 45% on Chinese EVs highlights the increasing tension. But here's the twist. Germany initially resisted these measures, worried about the ripple effects on trade. So whose interests are truly at stake? Volkswagen made a big impression at Auto China 2024 by showing off 44 models, including 6 brand new ones and 5 made specifically for the Chinese market. This event celebrated 40 years of Volkswagen's presence in China and highlighted its commitment to working closely with the country under its In China for China plan. But this wasn't just a celebration, it was a strategic move to cement their place in the world's largest car market. It raises an interesting question. Is Volkswagen leading the way or becoming too reliant on China? During the event, a key agreement was signed between Germany and China to work together on self-driving and connected car technology. The goal is to create global standards and ensure fair competition for companies in both countries. On the surface, this sounds like progress, but it also makes you wonder if this partnership gives China an even bigger advantage in a competitive global market. To fully grasp the implications, let's dive into the dynamic relationship between Germany and China and why it holds such global significance. Germany and China have built a fascinating relationship over the years. It's a mix of teamwork and rivalry, shaping global trade and geopolitics. Their partnership isn't just about money. It's about shared goals and tricky disagreements that could change the way the world works. Take trade, for instance. Germany sends billions of dollars worth of cars, machine parts, and medicines to China. In return, China floods Germany with computers, batteries, and electronics. In 2022, Germany's imports from China reached an impressive $195 billion, while its exports to China amounted to only $107.4 billion. It's like a conveyor belt running between the two, keeping their industries alive. But here's the twist. China sells much more to Germany than it buys. This trade imbalance has left Germany scratching its head, wondering how to balance the scales. Beyond trading goods, they're also investing in each other's futures. German businesses are pouring billions into China, building factories and sharing expertise. In 2023 alone, Germany invested a record 12 billion euros in China. Why? Because China's fast-growing market is like a gold mine for German industries. On the flip side, China's appetite for German engineering has kept thousands of jobs secure in Germany. But is it all beneficial? Not really. Germany is starting to worry it's leaning too heavily on China. What happens if that partnership starts to wobble? Politically, the story takes another turn. The two nations have teamed up to tackle big global problems like climate change and technology. But there are geopolitical tensions. For example, Germany isn't happy about China's support for Russia during the Ukraine crisis. And it's not just about politics, it's about trust. Can these two countries work together if they don't see eye to eye on global conflicts? Despite their differences, the numbers don't lie. China has been Germany's top trading partner for 8 years running. This relationship is too big to ignore. But here's the kicker. While they've formed partnerships in cars, energy, and tech, there's always an undercurrent of competition. Both countries want to be the leader, and neither wants to give up ground. With China potentially taking over Volkswagen facilities, we are about to witness the greatest rise and dominance of the Chinese auto industry. This could be the beginning of a total European auto industry takeover. Do you think Germany can maintain its position in the automotive industry? Or are we already witnessing the beginning of its decline? Share your thoughts in the comments. And don't forget to subscribe to the channel and turn on the notification bell so you don't miss future videos. See you next time.